In trading, pullback entry and breakout entry are two commonly used techniques to capitalize on market momentum and trend continuation, each offering distinct advantages depending on a trader's style and market conditions. A breakout entry involves entering a trade as the price moves decisively beyond a significant level of support or resistance, such as a key horizontal level, trend line, or chart pattern like a triangle or flag. Traders use breakout entries to catch the beginning of a strong move, betting that once the price breaches a critical level, increased volatility and volume will fuel a rapid price surge. However, not all breakouts are genuine. Many result in false breakouts, or fakeouts, where the price quickly reverses after breaching the level. This is why experienced traders often wait for confirmation, such as a candle close beyond the breakout point or an increase in volume, before entering. On the other hand, a pullback entry involves waiting for the price to break out first and then retrace or pull back to retest the broken level before continuing in the direction of the original breakout. This method is generally viewed as safer as it allows traders to enter after confirming that the breakout level has flipped into support or resistance, offering a more favorable risk to reward ratio. Pullbacks often occur due to profit taking or temporary market indecision, and they give traders the opportunity to enter at a better price with clearly defined stop loss placements just beyond the pullback area. While pullback entries reduce the risk of entering during a false breakout, they come with the possibility of missing the move entirely if the price never pulls back. Both strategies require sound technical analysis, patience, and a well-defined trading plan. Breakout traders may use tools like volume spikes, Bollinger Band squeezes, or consolidation patterns to anticipate breakouts, while pullback traders often rely on support at resistance zones, Fibonacci retracements, or moving averages to time entries. The choice between the two largely depends on a trader's risk tolerance, trading time frame, and overall strategy. Breakout entries suit aggressive traders who want to ride the momentum from the start, whereas pullback entries appeal to conservative traders who prioritize confirmation and better entry pricing. Ultimately, mastering both techniques equips traders with flexibility, allowing them to adapt to various market structures and conditions. In trending markets, pullback entries tend to offer consistent opportunities as price moves in waves, while breakout entries shine in consolidation phases, where price builds up energy for a sudden move. Understanding the strengths and limitations of each approach helps traders make informed decisions, manage risk effectively, and enhance their chances of long-term success in volatile financial markets.